companies will sometimes repurchase their own stock. When they do, we call this treasury stock. For the transactions we see here on the screen, we're told that this company accounts for the repurchase of stock, the treasury stock, using the cost method. This would be instead of going back to the par value that the stock was sold for or sold at initially. You can think of the cost that is paid for the stock and treat it as if that is the par value for the stock. So this company purchased 8,000 shares and they paid $15 per share for the stock. So to record this transaction, we would debit the treasury stock account. 8,000 shares times $15 per share would be $120,000, and then the cash account is going to be credited for $120,000 as well. Then on May 5th, sold 3,000 shares for $14 per share. Well, this is less than the amount that they had invested in it. That's okay. We can still prepare the journal entry. 3,000 shares at $14 would be $42,000. So the amount of cash received when it was sold, $42,000. Then go over to the right-hand side for treasury stock. 3,000 of those shares have been sold now. Remember, $15 per share was paid for this treasury stock, so we need to remove it with a credit to the treasury stock account. That would be $45,000. Now our journal entry will be out of balance. When we are short on a transaction like this involving treasury stock, we must debit the retained earnings account. So we are reducing the retained earnings account by $3,000 to represent this shortage. And then next on October the 12th, sold 1,000 shares of treasury stock for $16 per share. Remember, cost was $15. Now they're selling for $16 per share. 1,000 shares times $16 would be $16,000. We need to remove the treasury stock for the value, the cost method, for the cost we had in it. So that would be 1,000 shares at $15 per share. And then we have some overage. Think of this like a premium, like you would see if you were selling your common stock. We will have one of those additional paid-in capital in excess of the par value, actually, for treasury stock. So we just call this a PIC account. Additional paid-in capital for treasury stock, and that's going to hold that premium or that overage amount. Now, before we go to our last item, let me scroll down a little bit. I want to stress to you how important it is to keep up with the physical count as well as the financial account of treasury stock in a case like this. So here I'm just showing it. 8,000 shares purchased at $15, $120,000. We sold 3,000 shares, $15, removed it from the books and from the count. So then we would have 5,000 shares left at $15, a value of $75,000, removed 1,000 shares. So now this is our balance currently. 4,000 shares, they're valued at the cost of $15 each, would be a total of $60,000. We have to know that because if you look back up to the problem, they sold the remaining shares for $13 per share. Know that cost is $15, so we're probably going to have some shortage here. But we also had to know how many shares are being sold. Well, based on this physical count down at the bottom of the screen, 4,000 shares being sold. So that full 4,000 shares at $15, total of $60,000, has to be removed. Now, if we find that we are short, and we will, the first thing that we want to do is take it from this PIC account, and then if we're still short, we'll go to the retained earnings. Here would be the entry to record this last transaction. So cash, 4,000 shares at $13. Cash received, $52,000. Now, we got that part. Let's go down and remove that treasury stock. So treasury stock, we have that on the books at $60,000, so we're going to have to credit that account. We knew we had the cash coming in. So we are short. At that point, we would have had a debit of $52,000, credit of $60,000. So the next thing we do is remove, or we will debit, that additional paid-in capital account for treasury stock. That was $1,000. So that was a credit in that account, so we will remove it with a debit to that account. So that account is zeroed out now. We are still short. We're short by $7,000, so we are going to debit the retained earnings account for this $7,000. Now our journal entry is in balance, and the transaction has been recorded.